Hello, everyone. Hope you all are doing well. Had a great weekend ahead or behind you. Hope your weekend went well and hope you have a good work week ahead of you. We'll be talking about a few things today. We'll be looking at what Jerome Powell had to say at the past FOMC meeting, and then we'll be taking a look at Evergrande. This story is ever changing. So, I'm not so sure if I have the most up to date or current information with you. So, as always, feel free to chime in there. I will be taking a few look at a few things from Gerald Salente's recent trends journal, and we'll be taking a look at past interviews from Dr. Ron Paul and from Alistair McLeod. And just a heads up, the ebook giveaway, the question is going to come from the Dr. Ron Paul interview. So hope you all had a chance to go ahead and take a look at that. We'll be starting soon. If you could, just let me know how the audio is coming in, if it's loud enough for you guys. Really appreciate it. Harold B, how you doing? Ted Golden, Vincent, yes, Harold B. Harold B would like to speak to you. Vincent, are you in trouble? What'd you do? Jay Delaney, James Richter, Chris Primer, how you doing? Pablo Pina, aloha, aloha to all of you. Blue Dog, Red Dog, Blue Dog, Red Dog. First time I've seen your name here. Again, if you are new, go ahead and type in new and where you're from. See if we can acknowledge you. Nick Nasty, Patrick Bateman, greetings and salutations. So we'll be with you shortly, and let me know how the sounds coming in. Carrie Ellen Wilder, how you doing? Petro, I'll see you guys in just a bit. Mr. Nguyen, welcome aboard. Hello again, everyone. Welcome to another edition of Silver Bullion Television, SBTV. This is our bi-weekly live stream. Glad you could make it here and hope everyone has had a good weekend again. And again, appreciate you being here. Quick roll call. I had a chance to say hello to a few of you, so I'll continue on with Mutant Ref. How you doing? Inspector Jason, how you doing? First time I've seen your name here as well. Welcome aboard. Again, if you are new or your first time here, go ahead and type in new, where you're from. And one more thing, if you do have questions, go ahead and type in a Q in front of your name so we can go ahead and identify that it is a question. And then either I or Vincent will try and go ahead and answer that question for you. So again, Justin Strange, how you doing? Jay, self-evident, comfortably numb. Comfortably numb. Okay. Mahalo. All right. I can see someone else there from Hawaii. How you doing? Nick Nasty again. JR, how you doing from Melbourne, Australia? Parentheses, jail. How are things in Australia? I've been seeing reports where servers went down, media went down, and I guess basically coverage wasn't really being being forwarded to people to let them know what was going on. So I mean, I guess again, if you're in Australia, just let us know how things are. Daryl Porter, how you doing? First time I've seen you here as well. Welcome aboard. Looking sharp there, Daryl. Look at Daryl. That's a nice suit there, Daryl. All right. Looking good. Looking good. Okay, so Mr. Nguyen again. All right. Michelle Brienza, New Toronto, Ontario. Also, chill. What's going on in Toronto? I know your prime minister. He's been calling for some pretty progressive progressive positions there with the bugs. So again, yeah, let us know how things are wherever you are at. Appreciate it. Um, okay, so let's see. All right. So again, we'll be taking a look at a few things Gerald Salenti has said, his recent Trends Journal, Dr. Ron Paul interview. We'll be taking a look at uh, let's see, Alistair McLeod's interview, and then of course Jay Paul, what he said at the most recent FOMC, and Evergrande, the ever-changing story of Evergrande. So we'll be taking a look at a few of these things. Really do appreciate it. As always, if it is your first time here, go ahead and I hope you do subscribe. Click on the bell to be notified on updates, and thumbs up are always appreciated. Thumbs up, thumbs ups. We always appreciate the thumbs ups. Those are very, very good for us. You can always find us on social media. Silverbullion.com.sg is our website. You can go ahead and this is where you can purchase gold and silver, sell gold and silver if you have already an account with us in Star Storage. But more than a gold and silver dealer, we do specialize in wealth protection, systemic wealth protection. Again, as I always say, a lot of you folks already know what's going on out there. We are going to need options, and we do have quite a number of options that might fit what you are looking for. So go ahead, shoot us an email, sales@silverbullion.com.sg. We'll see what we can do for you. Silver Bullion SG is where you can find us on Facebook. Silver Bullion PL is where you can find us on Twitter. Instagram, Silver Bullion SG. Audio versions, bit.ly. SBTV iTunes or SBTV Spotify. And Crisis Tracker. If you have that Telegram app, go ahead and search Crisis Tracker. This is where Vincent and I, we go ahead and we will put in a few news items. And we, as I always say, we kind of sift through the weeds and find the ones that may be of value, especially if you're into precious metals, gold, silver, economy, finance, things like that, current events. So go ahead. If you have that Telegram app, whether mobile, on your mobile or on your desktop, go ahead and search Crisis Tracker, one word. And we'll get you in there, see what's going on in the world, try and filter stuff out for you. So again, appreciate you all being here. Aloha to everyone. And I'll move over to our upcoming guests because this is bi-weekly. We have two guests on before it is the next time that we see you. So the first guest coming up is going to be Egon Von Greyers, founder and managing partner of Matterhorn Asset Management and Gold Switzerland, based in Zurich. Egon forecasted the present problems in the world economy already back in 2002, and despite his start as a young banker in Geneva, I'd like to travel back through time and see that. That must be pretty cool. Egon Von Greyers as a young banker in Geneva and thereafter finance director and vice chairman of a FTSE 100 company in the UK. And Egon, he knows all too well why we should have assets outside the banking system like gold. So he'll be our upcoming guest, and our upcoming guest after Egon, I believe, is going to be Peter Schiff. So, Peter Schiff, if you have questions for Peter Schiff in our community group on SBTV, go ahead and put your questions in there. Or maybe if you want, go ahead and put some of your questions here in the comments. And we'll see, which ones we may go ahead and ask Peter Schiff. So, Egon Von Greyers, and then we'll be having Peter Schiff. So, again, hope you folks do sign up and click on that bell for updates. Moving on, our ebook thank you giveaway. Because we had Dr. Ron Paul on, we're going to be giving away his book once again, End the Fed. And in End the Fed, Dr. Paul draws on American history, economics, and fascinating stories from his own long political life to argue that the Fed is both corrupt and unconstitutional. Congressman Paul's urgent appeal to all citizens and officials tells us where we went wrong and what we need to do to fix America's economic, political, or policy for future generations. So we'll be giving this book away. And if you'd like to win it, download that Kindle app from your phone's or tablet's app store. It is free. Be one of the first 5 to answer correctly in this live stream before timer runs out. You have about a minute and 30. U.S. winners, you're going to be given a link. What will happen is my colleague Vincent, he is standing by, and what he'll do is he will mute your comments, and that way you can go ahead and put in your email, and no one will see it except for Vincent. And knowing Vincent for quite a few years, he is one guy you definitely can trust. Non-U.S. winners can ask Amazon to exchange the ebook for other things like gift cards, perhaps. And again, you have to provide us an email during this live stream. So with that, we'll be moving on to the question ahead. Just want to take a look at a few of the comments out here. Yeah, join our crisis tracker. Definitely, I think you'd like to. You'd want to join that. Let's see what else is out here. Yeah, Harold B. I like Egon as well. Let's see what else is on here. Okay, Texas, how you doing, Texas? And let's see what else is out here. Let's see. Okay, so we'll move on. We'll go to our question. So the question to win this ebook, it does come from the Dr. Ron Paul interview, and the question is: Dr. Ron Paul said the Fed will, in a blank way, end itself. The Fed will, in a blank way, end itself. Okay, so it's a one word statement. What he had to say, and the Fed will, in a blank way, end itself. So go ahead and take a chance. It's just one word. You never know. You may actually win that book. James Richter, Vincent for 2024. I'll vote for him. Yeah, Vincent, didn't know you were running. One day, Vincent's going to come on here. I know he will. One day, one day, one day. So again, let's see. The Fed will, in a Harold B. abrupt way, end itself. Okay, so answers are coming in. James Richter, a bad way. Silver Warrior, bad way. Glorious way. All right, spectacular way. Dramatic way. Catastrophic way. John Doe, a VA, blankety blank blank een way. Disastrous way. Mitch Alex. Let's see what else is out there. Perverted way. Carrie Ellen Wilder. Desperate way. Animax, how you doing? Okay, so yeah, it doesn't look like anybody's gotten it so far. Eventually, Patrick Bateman, and it is true, eventually it could happen there. Um, okay, well, the word we were looking for was technical, technical way. And I tell you what, this probably was a bit of a tougher question because, number one, I looked at the stats and I know for some reason, Dr. Ron Paul, 60,000 plus subscribers here on YouTube, and not even 5,000 saw that interview. So I don't know how that one kind of passed by a lot of people, but I guess it did. So it kind of makes sense why, we didn't find that answer of technical. But again, appreciate you guys all being here. Every one of you counts and matters. So yes, the word was technical, and we will revisit that interview from Dr. Ron Paul. But just curious, did you folks get a notification or anything, a recommended video that Dr. Ron Paul was up? Just curious. So anyway, here's his answer.
The Fed will, in a technical way, end itself. We've gone since '08, essentially, with quantitative easing, that there are no limits. And it surprises me a little bit that it's actually still functioning. People still trust the dollar because there's not much other option. We probably need a lot more education in our universities because if you go to 90-some% of our universities today owned by the government, and who also get support indirectly from the Federal Reserve itself. They get all these economic papers defending the Federal Reserve. It's a system that will self-destruct, even though quite a few people are surprised that this even works the way they do. Negative interest rates, yeah, I believe they're negative because if you factor in real inflation rate and you have interest rates at 1%, they're negative. And that is not the way to run an economy. It doesn't work.
Okay, so looking at some of the comments, yeah, I appreciate it. Seems to be a mixed bag out there, and yeah, you are right. I guess with this the live stream going every 2 weeks, it's kind of hard to remember, and like I told you guys before, even with the guys at work, I keep telling them, if you tell me something 5 minutes later, you better tell me again because I'm going to forget. So all the more 2 weeks. That's yeah, could be a longer time, longer gap. But okay, yeah, Nick Nasty, to answer your question, usually Wednesday nights, 9 p.m. to 12 a.m. Eastern, or if you're here in Asia, usually it'll be Thursday mornings about before noon, slightly before noon. So that's when we do to release the new videos. Anyway, with according to Dr. Ron Paul, the surprise is that with all the QE money printing, and the Fed is still functioning, and the dollar is still functioning. And to expand, perhaps even the U.S. government is still functioning. We'll see what happens with that debt ceiling again, starting to make headlines. But let me ask you guys: can the money printing continue? Can it truly continue? Because it has been continuing for over a decade already. We'll go back to 2008 when we first, or 2011 anyway, when QE first became part of our vocabulary. But if not, if you don't think this can continue, when does it end, or how does it end, or what event causes it to end? Don't need any dates here. Giving dates is never good, but I'd like to see what you folks think. If not, when does it end? I personally think it it's going to end, but we won't know it'll end because it'll just simply transfer over to something else, which could be things like central bank digital currencies. So I'm not sure if there will be a hard end, a definite end where everybody knew it was the end, but I think definitely there'll be a transition for sure. Anyway, here's another clip from Dr. Ron Paul.
Gold isn't the salvation. Cryptos is no salvation. And the only thing that really will protect us against an evil government is the freedom by the people to take care of themselves and acknowledgement that liberty is what we need. And that will take care of things. Under those conditions, you don't have a Federal Reserve. You have honesty and money, and you will have monetary authorities, and you'll still have government, but you would have to live within our means. You wouldn't be able to print money because that's fraud.
Okay, interesting the words he chose, evil and fraud. And looking at these comments here, Mitch Alex, yes, he can, but not forever. I'm in agreement with there. Jay Delaney, Mr. Powell slipped me a few trillion. Hey, slip all of us a few trillion. Why not? Let's see. Paul, it can continue, but will end. Ace is up. Silver says tomorrow. All right. Ace is up. Silver tomorrow. We'll see how that went during the next live stream if you were right. So, okay. With Dr. Ron Paul, hang on, let me just clear this up. It's not gold, it's not coin or Bitcoin, it's liberty. So let me ask you here again. If we had sound money, would you be stacking precious metals? If we had sound money, would you be into cryptocurrency? If we had sound money, would you be able to then focus on life, liberty, and the pursuit of happiness if you knew our money was sound, or our money would fight inflation and our money held its value over the course of our life and generations to follow? Would it be then easier to focus on life, liberty, and the pursuit of happiness? I think it would be. Let me take a look at a few more comments here. Let's see. Mm, uh, okay, Mitch Alex, that's a pretty good point there. I think other nations will start trading with other currencies and gold and will become the predominant money. That's interesting because as pointed out before, when you look at countries like Lebanon, Venezuela, and I've been hearing even Turkey, these countries have their own national currencies, and what happens is when these currencies get in trouble, they shift over to the U.S. dollar, perhaps the euro, and it that which is fine. But the question I then have is, let's say if you're in the U.S., what happens if your US dollar starts getting in trouble? What currency are you then going to use as an alternative? I mean, if the dollar is, you can't use the dollar. And then imagine the rest of the countries out there as well who are using the dollar as an alternative currency. So what then happens? And this creates a very big problem. And this is one reason why people look for shelter in a store of wealth, as such as gold, such as silver, and even why people are choosing to look at something like Bitcoin. So it's pretty interesting what he said there. And I'll move on to one more clip from Dr. Ron Paul.
We are hanging on to the dollar as the reserve currency of the world because it provides so many benefits to us. It gives us license to spend, license to waste and control, but it's getting a little bit shaky. And I think that's what the big news right now is. How shaky is it, and how distorted is the economy due to these tens of trillions of dollars and credits created out of thin air? A lot of debt, a lot of malinvestment, and a lot of distortion of wealth distribution. So the conclusion that we're coming to, and people have to realize, it is a creature of a monetary policy which makes no sense whatsoever, and it has allowed our government to overextend at the expense of freedom.
Okay, so let me take a look at a few comments. So first, Vincent, if you could, for Harold B, could you turn off his comments? He wants to send you a private message. So, okay, Vincent, if you could just go ahead and mute Harold B's comment. Appreciate it. Okay, so let's see. Looking out there, Daryl Porter, it's fraud. In fact, the Federal Reserve recognizes the dollar as a Federal Reserve accounting unit. Yes, they do. Denomination, and you take the first letter from each of those words. It spells fraud. Learn something new every day. Daryl Porter, good comment. Thank you for that. Jay Delaney, licensed to steal. Uh, a lot of people would say that, and a lot of people would agree for sure. Let's see, Mitch Alex. If we had sound money, if we had sound money, I'd probably be stacking uh, Fed Reserve notes. They'll eventually have collector's value. I guess that's what you meant there. Okay, so yeah, sound money does make a very very big difference. That's for sure. And then he goes on to say, we're in shaky grounds, basically. How shaky is it? I mean, do you feel the need, the urgency to go ahead and do something, do anything? What can you do? And what are you doing about it? And that's really what it comes down to, as we always say here. You need to have options, find the options, create options, explore options. I think one of the options that stand out. You look at gold, silver, then you look at crypto, and for some reason, people think there seems to be a wall between the two. That there's a bridge, a battle between the two. The two actually can work for you. The two can actually work for you. So go ahead and take the time to pride aside and go ahead and take a look at the other side and see what they're saying, and you just never know. Options are going to be important. And then we had Alistair McLeod come on, and he also had a few pretty important things to say, or pretty eye opening things to say. So here's a couple clips from Alistair McLeod.
The purpose of the taper is quite simple, and that is to rig financial asset values. The principal asset values that the Fed is interested in rigging, obviously, is the prices of government bonds. And what they do is they turn around through the banks, they go to pension funds and insurance companies, and they buy US treasuries off them to the tune of 80 billion a month and agency debt for a further 40 billion a month, a total of 120. And what do the insurance companies and pension funds do with the money? Well, they invested in other things. The idea is more risky things. So they will buy corporate bonds, let's say. They will buy equities. And that's why we have a bubble in equity markets and also in bond prices.
Okay, Harold B, I see your message. I'll take a look at it after the live stream. We'll see. We'll check in on that. Okay, so Alistair McLeod says the purpose of the taper is to rig financial asset values. Do you agree with what he said? That was interesting what he said about the taper. And then, of course, we had Jay Powell come out on FOMC, which we'll take a look at. He also talked about the taper and I believe even the purpose of it. So we'll take a look at that as well. Here's another clip from Alistair McLeod.
The fiat currency system is now so risky, both in terms of financial assets, physical assets such as residential property and so on and so forth, and also the currencies. If you look at what's happened to the purchasing power of the dollar, measured in gold, because it's the only measure actually which has any credibility, then since 1971, the dollar's lost over 98% of its value, its purchasing power. And now it's about to accelerate. The reason that paper currencies lose their purchasing power is purely down to the acts of governments. It's got nothing to do with gold. Gold merely reflects what governments have already done. So, it wouldn't stop the collapse of the paper currencies. That's why I would say I want out of this fiat money system. If, like me, you think that's what you should do, there is only one place to go, and that is physical gold and silver, obviously.
Alrighty, so this is interesting because both Dr. Paul and Alistair are saying words like risky, words like shaky. And if you want out of the fiat system, the place to go is gold and silver. And this goes back to, again, having options. And I don't mean options as in trading options. I mean having options in your personal life. In your personal life, make sure you have options, including the understanding of the shakiness, the risk of where central banks and government has put us today. So again, options may also include financial options outside of the current financial system because it is going to transition into something else. That I think all of us would agree. It is going to transition into something else. You want to make sure as it does transition, whatever you want to make sure that you hold the value in your assets. And again, the stores of wealth, things like gold and silver that can get you from this side to that side when the transition starts to happen and when it starts to evolve. So you want to make sure again you have those options. One more clip from Alistair McLeod.
The government currencies always fail eventually. So the only thing you can do, I think, is to protect yourself against this uncertainty. by getting some of your wealth, some of your assets out of the fiat currency system entirely and just put it into gold. I mean, that's about the only thing you can do. Gold and silver. If you look at history, I mean, 5,000 years, we know that gold has been money. It's the money of the people. Silver is the money of the people. In the absence of fiat currencies, silver is going to come back. Gold is going to come back. It always has in the past. All I can say is that it looks to me the symptoms of where we are in terms of this currency game, which I've now called the funny money game, which is really what it is that we're coming towards an end of it. And under those circumstances, there is only one thing you can do, and that is physical precious metals.
Alrighty. Government currencies always fail eventually. An interesting statement because where then do you put Bitcoin and cryptos? It's not government money. So if government money fails, well, gold is not government money. Crypto is not government money. So again, these may be options. It's created by the people for the people. And nonetheless, yes, history tells us fiat fails, always does. So specifically for our US viewers, what other currencies do you hold? What other currencies do you hold that are either legal tender or easily tradable outside of the US dollar? And that's important because as I was saying, other countries, they have a local currency, and if that local currency gets in trouble, they can go to the US dollar or some other currency. But again, if you are in the US and you have a US dollar and US dollar starts to vibrate a bit too much for you, what do? What currency do you have out there? So moving on to Gerald Celente, his most recent trends journal. Take a look at a few things here. Market correction, gold and silver. We tell you only what we want you to know. And nickel is the new gold. So Morgan Stanley's research note predicted the Standard & Poor's 500 stock index is likely to plummet at least 20%. Okay, so they're expecting it to go down 20%. The report sketches two scenarios for U.S. equities. One, the analysts call fire, and the other they call ice. The typical fire outcome would lead to a modest and healthy 10% correction in the S&P. And they wrote, with the U.S. Federal Reserve dismantling its stimulus props to keep the economy from running too hot. In an ice future, the S&P would plunge by at least 20%. So will it be fire or ice? Nobody knows, the analyst wrote, but the ice scenario would be worse for markets, and we are leaning in that direction due in part to slowing growth and declining consumer confidence, according to recent polls. We think the mid-cycle transition will end with the rolling correction finally hitting the S&P 500. They said, let me move on to gold and silver. Trends Journal continues to forecast that gold and silver prices should be much higher. However, they maintain that there will be prolonged pressure in the bankster money junkie world, the funny money world, to keep equity markets rising and keep precious metal prices down. Why? Because when markets crash and precious metals spike, it'll signal to an out-of-touch Main Street the true calamity of the deeply in-debt public and private sectors who have artificially inflated economies and equities. Indeed, a front page article in the Wall Street Journal recently said one aspect of soaring debt levels and gamblers' addictions were junk debt sales soar towards a record year. That's right, junk. The journal notes that according to the S&P Global Market Intelligence, junk-rated bond debt now tops the precious 2008 high. So yes, junk bonds more today than they were back in 2008, as in the panic of '08. Let's see. Moving on to we will tell you only what we want you to know. This is interesting. Fox Corp and News Corp, its parent, are continuing to gobble their way through the world's media menu, adding more than 20 properties for almost $7 billion since Lachlan Murdoch took leadership of the company from his father Rupert back in 2019. Recently, Fox grabbed website TMZ, dedicated to celebrity gossip, celebrity gossips and their memes, right? For something less than $50 million, according to the Financial Times. In 2019, the Murdoch empire sold most of its 21st Century Fox to Disney, which is another big boy, for $71 billion to concentrate on news, sports, and television. Since being Fox's CEO, Lachlan has pushed the company more broadly through those areas, spending $1.5 billion on 8 purchases that encompasses sports betting, blockchain technologies, and online streaming. So as Gerald Salente says, the bigs keep on getting bigger, and we're going to have less choices out there. Nickel is the new gold. This is interesting. British minerals giant Rio Tinto has bought into a U.S. nickel project of Talon Metals. Australian mining company IGO is negotiating to take over competitor Western Areas and BHP. And Wyloo Metals are wrestling over Noront Resources, millions of tons of nickel in northwest Ontario. Basically, there's sort of a shakeup going with nickel. Guys are really trying to claim their stake right now. So BHP entered the fray after deciding last month to sell its oil assets and turn to more future-facing minerals. This is what the CEO said. We see an increase in mergers and acquisitions in nickel, which is driven by the need for sustainable nickel that's outside of the Chinese supply chain, said metals consultant Stephen Brown. And people are looking to de-risk the supply chain by reducing dependence on one country. And people are looking for clean nickel. As many of you know, there are a few different types of nickels, mainly class 1 and class 2. Class 1 is the cleaner nickel used for electric vehicle batteries. So people are looking for clean nickel as countries seek to abide by their pledges under the Paris Climate Agreement. For example, the European Union has proposed beginning in 2024, only batteries with a carbon footprint declaration can be sold in the Eurozone. So changes are coming, and that would then ban car makers from using batteries containing nickel from Indonesia, which ranks 12th in the world for coal consumption. Basically, car companies are willing to pay a price premium for nickel sustainably produced. They're looking to de-risk the supply chain by reducing dependence from one country, and people are looking for clean nickel as countries seek to abide by their pledges under the Paris Climate Agreement. So that's a look at our past guests and Gerald Salente's Trends Journal. Interesting what he had to say about nickel. Speaking of nickel, moving over to our website, silverbullion.com.sg. Let me pull it up here. Visit us at Millennial Walk. Yes, we are going to be moving house. We're going to be in Millennial Walk in Singapore, which is located in a mall. So that'll give more hours for people to come and visit us. This move is happening fairly soon. Will be October 15th. So I guess we're all going to have a lot of work to do. Maybe after this, I better go down and see if we need to help the guys carry things over there. Silver and gold, U.S. dollar. Silver up some 21 cents at 22.70. Gold, 17.58, up some 7.60. Basically, not too much of a change, despite the FOMC, despite the what's going on with Evergrande. Nickel, 19,100 a ton. It's been flirting back and forth between high 18 and 20,000. Again, nickel, we do have the clean nickel, the class 1 nickel, if people would like exposure to nickel. This is the physical nickel. If you would like exposure to the nickel price, being, again, especially how electric vehicles and their batteries, which nickel is a huge part of and plays a role in, this will be something to look forward to, just as that article from Gerald Salente pointed out. So take a look at nickel, study up on nickel, and see why we sell nickel, why a lot of people will be looking at it. Investor Kit, this is free. Go ahead, click on it. You can either look at it on the website or download it. Storage sign up, it is free, no maintenance fee. Again, options have this option ready for you if you ever need it, or if you would like it now. Go ahead and sign up for it. It is free. And then we have silver to gold ratio 77.5. So we're still kind of nipping at that 80 level. Our recent Metal Money interview with Francis Hunt, we talked about this. I do hope you folks had time to go ahead and take a look at it. And Francis Hunt had something to say where he said, precious metals investors, we're just basically seen as wrong until we're right. So during the time where supposedly we're wrong, maybe a good time to be accumulating. And right now it's 77.5. Silver would be the preferred metal to be accumulating right now. So it takes 77.5 ounces of silver to equal 1 ounce of gold price wise. Price wise. But again, remember the ratio coming out of the ground is about 9 or 8 ounces of silver to every 1 ounce of gold. So there is a big disparity between physical and a paper trading price. Featured products: 1 kg metal ore bars, 1,000 ounce silver LBMA bars. These are always good. Let me take a look at these. Typically, these have the lowest spread, so this is why guys are interested in getting LBMA bars. In stock, 454 bars in the vault for you to own. You go ahead and you buy it, and we can store it for you. It is entirely in your name and your name only. And 2 bars that you can go ahead and pick up from the shop. Be sure to bring a trolley. If you're interested to store it with us, you'd have to sign up as a silver bullion user. Different accounts: personal, joint, trust, joint account with a minor, a business account, and your retirement account, precious metals IRA. I think this is going to be this will only grow as people start to understand. Especially when it comes to your retirement, you may not want to keep it all in fiat. You may be looking at something that can store the value. Otherwise, with things like inflation along the way that are coming along the way, it is going to chip away at your retirement account if it's entirely in fiat. So understand and learn about precious metals IRAs and what they can do for you, and how we can help you with it. As a sample account, a personal account, really it's basic information: name, first name, last name, mobile number, email, country of nationality, preferred currency, all basic things. And when it comes down to references, we are at the bottom. You'll have to come all the way down and make sure you type in YouTube SBTV. That'll help us out a lot. Do sign up for newsletters. We don't send them out very often, but they are usually packed full of information when we do. And I would suggest you would like to receive your notifications via encrypted, secure notification. This means that the body of the email is not sent out. All you would get is a notification that you have an email, and you can go ahead and log in here with us and see what your email is. Google, Hotmail, Yahoo, all of those guys, they won't be able to see it as they should. They should not be able to see it anyway. So it's just between you and us. So hope to see some of you signing up for an account. Moving over to Twitter. Let me see here what's going on. Let me take a quick look at comments as well. Okay, so Twitter. This one's interesting. What I believe this is Druckenmiller, what he had to say. So let me go ahead and put the volume on and start from the beginning here.
But let's start with the Fed and inequality. I don't think there has been any greater engine of inequality than the Federal Reserve Bank of the United States the last 11 years. So hearing the chairman talk about visiting homeless shelters is very, very rich indeed. I just had the best year I've had in 15 years last year. Everyone wealthy I know is making a fortune. And why are we making it? Because this guy is printing money like there's no tomorrow. And the kids in Harlem, in my opinion, are not benefiting from money printing, but Stan Druckenmiller and other wealthy people are. So for the life of me, I can't figure out why the left is so excited about money printing when all the data says the people that benefit from money printing are rich people that know how to navigate the markets. The odds-on bet is we're going to have inflation, and inflation is going to hurt poor people, again, a lot more than rich people. How does this thing end? To me, the asset bubble, which he's blowing up into unbelievable proportions, busts before the inflation ever really manifests itself. That's what happened with the housing thing in 08, 09. We never really got to the inflation because the asset bubble burst. Not dissimilar to what happened in 29. That's not my central case, but let me just say, we've never had a deflationary bust because inflation was too close to zero or 1.5 instead of 2. We've had them because we've had these tremendous asset bubbles. It happened here in 29, it happened in Japan in 90, and obviously it happened in the great financial crisis. And there is no group that will get hurt more by a bust than the poor. They will be first in line to get screwed. Trust me.
Okay, so interesting what he had to say there, and I guess it is true. All that money printing, and it's really the rich got richer basically, and we've seen that all throughout the, work from home and all of these lockdowns and things where the billionaires became multi-billionaires. So it is true. We've seen that. Tracy, CBDC is the invisible enemy. MSM will have you focus on everything else but this. Wake up. We'll touch on this in a bit because there was an article that came out that we'll show you. John told silver miners can't expect me to invest more when they lack the courage to stand up to the cartel. And interesting word he used is cartel. I mean, OPEC, we have a cartel, the banking cartel, and I'm starting to wonder even in shipping if we're starting to have a cartel. I understand that there's about six companies that own or have part in about 70 plus percent of the world's shipping. Six companies, 70 plus percent of all the world's shipping. So I'm starting to wonder if there's even a shipping cartel that perhaps maybe driving up shipping prices. Who knows? But as Gerald Salente says, the bigs are getting bigger. Article from Bloomberg of Berlin referendums. So if any of you out there know about this, do chime in. Will decide whether the government should take control of private apartments to protect affordable housing. So there was an election that went on where voters will decide whether the government should take control of apartments from the biggest landlords to protect affordable housing. Okay, so that, I mean, it has some pretty serious undertones, undercurrents beneath it. I would think. John Solomon, IRS would track all bank transactions over $600 under Biden plan. Business revolt. Just the news. So the IRS is looking to track all bank transactions over 600. I mean, first it was what a few thousand that you had to give them the reason why you were going to withdraw money or what you're going to use it for or whatnot. And now they're looking at tracking transactions over $600. And that's, I mean, what's less than $600? Maybe your groceries, your fuel, things like that. But $600, I mean, that's a lot of things are over 600. Well, maybe not car payments, but your mortgage for sure, whatever else it may be. But IRS wants to track it. So again, we'll see how this pans out. Mohammed El Irian, also from The Economist. This week's edition has two articles of particular interest to those looking for a primer on China's Evergrande challenge, including the pros and cons of the government attempting to impose an orderly default, the marketized default. I think this may be a word that we may start hearing more. Marketized default. So China's financial authorities are honing a new skill, the marketized default, or an orderly market exit and well-managed restructuring for troubled companies. The term has surfaced in government documents as regulators manage larger, more frequent, and highly complex defaults. They have had some success. Evergrande, or Grande, however you wish to pronounce it, a massive Chinese property developer on the brink of collapse, is proving to be anything but. Okay, so that's a look at a tweet from Irian. Okay, El Irian. Let's see. In short, despite some taper talk, inflation is not looking transitory and policy is nailed on easy for at least another year. Okay, what else is out there? Chinese officials have taken steps for months to crack down on cryptocurrencies with mixed effects. This time they've made their intentions clear. Keep an eye on this. This is going to be interesting to see how it unfolds, but China's getting a bit more serious now. Chris Marcus, Arcadia. Please, oh please, God, let Nancy Pelosi and Joe Biden suggest $1 trillion coin as a solution to the debt ceiling next week. This idea, I think most recently we may remember it during Obama's term where they floated the idea of a $1 trillion platinum coin. We're starting to hear chirps about it again. The $1 trillion coin idea is back. If it's debt ceiling crisis reason, then, or if it's debt ceiling crisis season, excuse me, then it's also time for the craziest solution of the problem, getting President Joe Biden to issue a $1 trillion commemorative platinum coin. That's the idea that they're looking at floating. So, should you get platinum? Well, I think you should have some platinum anyway. But we'll see how this opens up as well. Sorry, a lot of these articles are on Bloomberg, so I can't really open them up. So I'm just kind of going by here. Rethinking the dollar, Evergrande debt crisis ensnares mom and pop investors. So, and this is why a lot of people feel that the Chinese government, I think they really wanted to stay out of this, but there's a difference between the way this type of a crisis will unfold in the U.S. and the way it is unfolding in China, and we're going to touch on this when we look at Evergrande. So I'll end the Twitter uh, peak. I'll end the Twitter peak there. Let me get back to the comments here. Let's see. Absolutely, big government is a major global problem. That without question. So we'll be moving on to the topic of the day. And yeah, running a bit late here. The Fed jawbones and Evergrande. The Fed jawbones and Evergrande. So the Fed had their recent FOMC meeting, and as expected, interest rates didn't move. The bigger attention was drawn to will and when the Fed will taper. So I believe this is Steve Leisman chiming in.
Rates were unchanged in the statement here, but the Fed said that if economic progress continues, reducing asset purchases may soon be warranted. I'll give you the exact language on that in just a second. The sectors affected by the pandemic, the Federal Reserve said, have improved in recent months, but the rise of COVID cases have slowed the recovery. And whoever, I think it was David Kelly, said it was right. They did lower the forecast for 2021 GDP. Back to that in a second. Decision was unanimous. Now, the median forecast now calls for a rate hike in 2022. 9 rate hikes were called for in 2022, 3 of which actually call for 2 rate hikes. The funds rate seen hitting 1.8% in 2024, so quite a bit of work to do. Unemployment rate is forecast, the median is slightly higher, 4.8% instead of 4.5, and a few other things. Somebody was talking about inflation there. They did pull up the inflation forecast, or at least the median forecast of all 18 members, to 4.2 from 3.4. It remains above 2%, interestingly, through 2024. This is our first look at 2024. And GDP was indeed pulled down. I'll give you that number there, 5.9% from 7%. So they took 1.1% off of the GDP forecast for this year. And next year, actually, they put a little bit back, about a half a point, 3.8%. So they're still seeing above trend growth through 2023. So I don't know what you want to call this. The pre-warning of a taper is the way you'd want to put it. They kind of put it in there. The exact language I will give you here. Let me just offer you that, what they exactly said there on tapering. And it was, if progress continues broadly as expected, the committee judges that a moderation in the pace of asset purchases may soon be warranted. So maybe it's time to think about putting on your seatbelt eventually for when the Fed eventually announces sometime in the future that it will taper.
Alrighty then, so let's break it down. Rates unchanged. But if economic progress continues, reducing asset purchases may soon be warranted. Reducing asset purchases meaning taper. Reducing purchases, tapering. So if the Fed reduces asset purchases, what really does it mean? And we'll go ahead and go back in history to see what it means. An explanation of Fed tapering and its impact on the markets. This was written back in October 26, 2020. Tapering, and from thebalance.com. In the financial world, refers to the winding down of certain activities by a central bank. One program that saw tapering in 2013-14 is QE, Federal Reserve's purchase of assets, including mortgage-backed securities and other assets with long-term maturities, to help bring down interest rates. Okay, so it's a bit different back then. QE was put in place in response to the 2007-2008 financial crisis. The Fed hoped the program would help banks feel comfortable lending money again. The program was meant to temporarily stimulate the economy, and after the Fed saw a favorable impact on inflation and employment, it announced that it would taper its buying program. In other words, it would purchase fewer assets each month. So let me go down here. Bernanke, he made a statement that in a news conference after the Fed July 19, 2013 meeting that while stating that QE easing policy remained in place, the Fed chairman also said that the policy was dependent on incoming data. Okay, so it all depends on what they're seeing. Given improvement in the U.S. economy, he expects the data-driven approach would prompt him to begin to taper before the end of 2013, with the program ending entirely in 2014. We know this did not happen. It did not end entirely. We had a taper tantrum. So, with this as the background, the markets expected tapering to occur at the Fed September 18, 2013 meeting, but central banks surprised the markets by electing to keep QE at 85 billion per month. And this is kind of what we're seeing. Powell is jawboning, taper, but we're not seeing it yet. And what happened with the market? The reaction, it didn't represent an immediate shift. It nonetheless frightened. It frightened the markets. And in the recovery that followed the 2008 financial crisis, stocks and bonds both produced outstanding returns despite economic growth that was well below historic norms. So again, markets seem to have disconnect. Consensus was that the Fed policy was the reason for this disconnect. And in late 2013, a widely held belief was that once the Fed began to pull back on its stimulus, the markets would start to perform more in line with economic fundamentals. In this case, that meant weaker performance. Bonds sold off sharply in the wake of Bernanke's first mention of tapering, while stocks began to exhibit higher volatility than they had previously. However, the market subsequently stabilized through the second half of 2013 as investors gradually grew more comfortable with the idea of a reduction in QE. So it does take time, and markets, they do, they are, bonds are going to sell off, markets are going to get volatile. It's basically what happens when they go ahead and taper. And now we're seeing rate hikes called for in 2022. And from everyone I interviewed, they all without hesitation said the Fed needs to get interest rates at about 4 to 5% because historically, when recession hits, the Fed drops the Fed funds rate or the interest rate by 4 to 5%. So again, what does history tell us? So we'll take a look at the Fed funds rate. The gray bars, the vertical gray bars going up and down, they indicate recessions. So if we go back here, let's just go back to 1970. We can see we were at about 8.9%, and we went all the way down to 3. So that was a 5%. The Fed needed to take down interest rates 5%. Here we were at, in 74, 12%. Fed had to go all the way down to 5%. Here we were in, let's just say, 80-ish. Fed was at 19%. They had to go down to 8% more recently. Let's just move over to 2000. Fed was at 6.4%. They had to go down to 1.75%, so roughly 5% again. 2010, the Fed was at about 5.25% interest rate, the Fed funds rate. They had to take it down to 0. And here we are today, most recently, 1.58%. Actually, we can go to, they were at about 2.5%, and they went down to 0. Okay, they had to go back down to 0. So this time around, guys are thinking we may only get to about 1.5%. And as you can see, each time it's lower and lower and lower and lower and lower. It will be lower once again. So there's just, guys are saying there's just not enough runway there this time around. So the problem we excuse me, I should be here. Whoops, hang on. Let me see. Yeah, should be here. So the problem we have today is that, again, brilliant people I'm so privileged to talk to say we'd be lucky if we can get to 1.5%. Lucky if we can get there. Now, if 1.5% Fed funds rate hits, or we get there and then recession hits, history tells us it will. History tells us the Fed will need to lower rates by 4 to 5%, and then we have a Fed funds rate going negative. In about June of 2019, before the repo market broke, I think you guys will remember this. This is even before COVID broke. Okay, the Fed funds rate was at about 2.5% or so, which I just showed you, and the markets were going south, and the Fed had to drop interest rates all before the repo market popped, all before COVID. So the one truth that Jerome Powell did say at the time was that interest rates would not go negative, and he kept his word. I remember him clearly saying this: "We are not going negative." He clearly said that. But next time, though, I doubt if he makes this remark, he'll be able to keep it. I really don't think so. And inflation to remain above 2% into 2020. I mean, we know that. That's not news for us. We know this. I mean, I think the Fed is just really trying to paint the best picture they can, regarding inflation, and not create some type of a panic. So they're really, really trying to sugarcoat what's going on. We know it's going to be more than that, so all the way into 2024. So, on the count of three, because this isn't news, on the count of three, let's all do a Greg Manarino, duh.
Duh, 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 duh. So duh, duh. He deserves a duh, duh.
Yeah, that deserves a duh for sure. And the rest is yada, yada, yada. Put on your seatbelts. Put on your seatbelts, not because the Fed is taking us on a field trip, but because the markets are going to twist and turn, probably even crash and burn. But here's a couple more things that came out of that FOMC meeting.
The test for beginning our taper is that we've achieved substantial further progress toward our goals of inflation and maximum employment. And for inflation, we appear to have achieved more than significant progress, substantial further progress. So that part of the test is achieved in my view and in the view of many others. So the question is really on the maximum employment test. So if you look at a good number of indicators, you will see that since last December when we articulated the test and the readings today, in many cases more than half of the distance, for example, between the unemployment rate in December of 2020 and typical estimates of the natural rate, 50 or 60% of that road has been traveled. So that could be substantial further progress. Many on the committee feel that the substantial further progress test for employment has been met. Others feel that it's close. They want to see a little more progress. There's a range of perspectives. I guess my own view would be that the substantial further progress test for employment is all but met. And so once we've met those two tests, once the committee decides that they've met, and that could come as soon as the next meeting, that's the purpose of that language, is to put notice out that could come as soon as the next meeting. The committee will consider that test, and we'll also look at the broader environment at that time and make a decision whether to taper.
All right. So in other words, yeah, we got inflation. Hot. We got inflation and it's getting hot, baby. Now the test is how to get you. Yes. You, all of you out there, how to get you back to work. So how are they going to get you back to work? I mean, you think the government will cut the stimulus? Kind of hard to do now. We talked about this before. You put the punch bowl out on Wall Street, you couldn't take it away. You put it out in front of Main Street, going to be tough to take it away as well. So if you did that and you're a politician, you're not going to vote for them. Okay, the politicians won't get the vote, and unless these politicians are on the way out, and not really care, maybe they may do it. But politicians nowadays, they really don't seem to really give a what. Or businesses will have to raise wages to get you back to work, and that is possible if they pass on the cost of business to you, pass it on to you. So when the Fed says inflation above 2% into 2024, they're not lying. And Powell uses the word test. What is going to be tested is your pocketbook. That is the real test. Your pocketbook is going to face this test. Your patience is going to face this test. Your peace of mind is going to face this test. So as Lehman said, buckle up.
This is an approach that the committee will broadly support, and it will put us, having completed our taper, sometime around the middle of next year, which seems appropriate. The asset purchases, as I mentioned, were very, very important in the early stages of the crisis. They were essential in restoring market function in the Treasury and other markets. Then as the recovery got going, they supported aggregate demand, as they will do. And now we're in a situation where they still have a use, but it's time for us to begin to taper them. Their usefulness is much less as a tool than it was at the very beginning. And of course, this leaves the whole question of rate increases ahead, which is really where the framework is all about how we deal with rate increases and that sort of thing. So we think this is the appropriate way to go. And again, broad support on the committee.
Okay, saw an interesting comment. Let me pull this up here. The Fed is really just focusing on employment at this point. You know, guys, we'll go back to 70s, 80s, or 70s, I should say. There was another president who was focused, who had on his lap inflation and employment, and he chose to focus on employment, or he had the central banks focus on employment. And then we had runaway inflation, and that president, I believe, was Nixon at that time. Um, this is nothing new under the sun. You know, these same sets of circumstances are happening again, and they chose employment as they are choosing employment now over inflation, and we ended up having runaway inflation. I think we went all the way up to some 17, 18%. Keep an eye on it, guys. So you heard it. This is all about rate increases. I mean, as you folks already know, I mean, as you folks bought homes, especially adjustable rates or mortgage, it's going to go up. The loans that the Fed wanted you to take to stimulate the economy, payments are going to go up. And this, I mean, take it with a grain of salt, because what the Fed is doing in the creature cave is to get those rates up so that they have that 4% or so recession runway that we showed you earlier. They need that recession runway. So this is really all about getting that rate back up so it can go back down. The truth is, we probably won't have that 4 to 5% recession, or my opinion, and a lot of other opinions anyway. So as a result, we may see inflation get worse, since the Fed cannot raise rates to cool inflation, as Volcker did back in the 70s, 80s. History again tells us that a currency inflates. People either look for another currency, or the government and central bank create a new currency. And there is actually talk of a new currency, correct?
Thank you, Mr. Chairman, for taking the question. I just wanted to check in with you to see if you have an update at all on the efforts from the Fed to develop a central bank digital currency. I believe that the report was supposed to come this summer, and indications that it's going to come this month. But the drumbeat seems to be kind of getting louder to see where the Fed's heading on this, and just wondering if you can provide some update there.
Sure, I'd be glad to. So we think it's really important that the central bank maintain a stable currency and payment system for the public's benefit. That's one of our jobs. We also live in a time of transformational innovation around digital payments, and we need to make sure that the Fed is able to continue to deliver to the public a stable and trustworthy currency and payment system. So there's extensive private innovation, a lot of which is taking place outside the regulatory perimeter, and innovation is fantastic. Our economy runs on innovation. But where the public's money is concerned, we need to make sure that appropriate regulatory protections are in place. And today, they really are not in some cases. So with that in mind, and with the creation of myriad private currencies and currency-like products, we're working proactively to evaluate whether to issue a CBDC, and if so, in what form. We have two broad work.
Okay, I'll stop it there. So they're still looking. They've been looking at CBDCs for how long? Which means basically he's buying time. You know, he's buying time. But you know, there was an interesting article regarding CBDCs that came out from Time. Let me make this a little bit bigger here so we can all see it. Let's see. Okay, so the U.S. is losing the global race to decide the future of money, and it could doom the almighty dollar. So this article, after I read it, you know, there is a bias towards we need to have a CBDC. So this article is biased. It is a bit slanted, just to let you know ahead of time. So in cities across China, the country's central bank has begun rolling out the e-renminbi, an all-digital version of its paper currency that can be accessed and accepted by merchants and consumers without an internet connection, credit, or even a bank account. You got that? They don't need an internet connection for it. Already having conducted more than 5 billion in e-renminbi transactions, China has opened its digital currency up to foreigners. Next year, when Beijing hosts the Winter Olympics, authorities are expecting to let the world drive its technological achievement. The U.S., by contrast, is having trouble even concluding its multi year exploration into the possibility of an e dollar. In fact, an upcoming Federal Reserve paper on a potential U.S. digital currency won't take a position on whether the central bank of the U.S. will or even should create one. So this is why you keep hearing, Powell just kind of buying time and buying time. But you can bet they're really working on something in the background. But here they say the central bank won't even take a position if they should create one. Instead, Federal Reserve Chair Jerome Powell said in recent testimony to Congress this paper will begin a major public consultation on central bank digital currencies. Once planned for July, the paper's release has since been moved to September. Once the world leader in digital payments and technological innovation, the U.S. is being outpaced by its top global adversary, as well as much of the industrialized and developing world. So we'll move over to Evergrande, but let me switch over. I mean, I think everybody knows we're kind of headed to the central bank digital currency, and you got to kind of wonder uh, why is the U.S. in last place right now, or seemingly in last place? I mean, they keep saying they're studying it, and I personally, this is my personal view. I don't really care for central bank digital currencies, but I do understand that this is where the world is going. So of course there is a bit of a bias towards that CBDC, and in that bias, why is the U.S. lacking so far behind? And we've even seen this with nickel. You look at countries in Asia, countries in Europe, they are way ahead with nickel and electric vehicle batteries, and the U.S. is really lagging behind. So you got to kind of wonder what's going on right now. But anyway, nonetheless, let's move on. Let's take a look at Evergrande. And it's been in the news lately, so I want to again take a look at it and see how it's unfolding and possible outcome, what the possible outcome might be. So we saw this article like this come out earlier in the week. This was September 16th, where China's embattled developer Evergrande is on the brink of default. So here's why it matters. So snowed under its crushing debt of 300 billion, Evergrande is so huge that the fallout from any failure could hurt not just China's economy. Contagion could spread to markets beyond China, and this is when we saw U.S. markets take a tumble. So here's how big Evergrande is and how bad its debt problems are and what's next. So it is on the brink of collapse with far-reaching implications. Let me go down here. So how did we get here? Let's see. The world's most indebted property developer has been scrambling to pay its suppliers and warned investors twice in as many weeks that it could default on its debts. So last week, Evergrande said its property sales will likely continue to drop significantly in September after declining for months, making its cash flow situation even more dire. So if their cash flow starts to slow down, the suppliers that they need to pay, their cash flow is going to slow down. So the developer is so huge that the fallout from potential failure could hurt not only China's economy but the markets beyond. So let's go down here. Let's see. Ratings agencies have repeatedly downgraded the firm, changing or citing its liquidity problems. And the problems infested or intensified last year when China introduced rules to rein in the borrowing costs of developers. And those measures place a cap on debt in relation to a firm's cash flow, assets, and capital levels. Okay, so what does Evergrande do? They own more than 1,300 real estate projects in 280 cities in China. Its property services management arm is involved in almost 3,000 projects across 310 cities. Company has seven units dabbling in a wide range of industries, including electric vehicles, healthcare services, consumer products, video. Basically, what happened was Evergrande moved off their core business, which was real estate. They moved out of their core business and into other things. And this is where the problems started to happen. They started using selling bonds and debt financing to go into these non-core business entities, or the non-core businesses. Basically, what they went into. So who's going to be affected? Banks, suppliers, home buyers, investors. Evergrande warned this week it's escalating troubles could lead to broader default risk. It said if it can't pay its debt, it may lead to a situation of cross default, where a default triggered in one situation may spread to other obligations, leading to broader contagions. So people who may be affected: banks, home buyers, and investors. And these guys are getting loud. Home buyers and investors, they're turning up and they're turning out to protest. And suppliers, I mean, if you supply this company, you may not be getting paid on time. So again, it is spreading within China, but that's the key word, within China. So the thing is, basically, everyone and their grandmother is saying that the Chinese government is going to have to bail out Evergrande. Well, I know one guy who says China is not going to bail out Evergrande. As China does insulate itself, its economy does have its own internal risks as well. I mean, one of its biggest, if not the biggest real estate company, I believe Evergrande, won't be able to pay its interest. What does this also say about the Chinese economy?
Well, the reason this wouldn't happen in the UK economy or in the American economy is basically the government would bail it out. And they would bail it out by extending credit. Now, China isn't going to do that. China knows that is not the route to long-term stability. If someone gets into trouble in the private sector, then they've got to face the music. It's as simple as that. There is no sympathy for businesses that get it wrong. There is no sympathy for businesses which have overextended themselves in debt. They do realize this, and I think that their actions, or we might call it lack of action, to support this failing company, to my mind, is wholly consistent with the Chinese view that they shouldn't support bust businesses, and that the economy is far healthier if capital is properly allocated. And on that basis, there will be, they will at least have some insulation from the rest of the world, which is following the path of expanding credit at the drop of a hat. And so I see this as consistent with the overall policy of trying not to go our way. Let me put it that way.
Yeah, that almost sounds like a. Okay, so I was gonna say that almost sounds like a capitalist economy. What they're doing there, but in moving forward with this, in China's Evergrande's rising default risk shift focus to possible Beijing rescue, and this is true. Okay, this is true. Let me go down here a bit. Hey, where is the? Okay, so anyway, let me just see here. Oh, I reached my article limit. All right, I guess one day we're gonna have to buy subscriptions to all these different places. But basically, what it was saying was that it does look like China may have to step in, and a lot of it had to do with because of there are protests that are starting to come up, and it's a big deal when people protest in China. It is a very, very big deal. And the thing is, why aren't we seeing Evergrande though turning into China's Lehman? Okay, why aren't we seeing this happen? Here's one reason why. Okay, so let me go down. We'll play this clip here. So let's just kind of get through the ad. Okay, so okay, we'll just wait for this thing to end. But when people start protesting in China, it is a big deal, and the government takes that very, very serious, as well they should. If you know the history of China, it's a big deal. So let's get through this ad, 10 more seconds here, and this gentleman is going to give you the reason why you may not see a Lehman happen in China, and it's pretty interesting what he had to say.
Issue from a common. The Evergrande is quite a separate issue from a common prosperity. The main reason for the Evergrande company to be in trouble, to be in default, is that it overly expanded. and the impact is huge. How large? It is about 3 to 4 times as large as HNA, the airline, the Hainan airline. It's also 3-4 times as large as the CFLD, the other developer. Okay, the main reason is it overly expanded. Okay, and what is prospect of the Evergrande and its impact on the Chinese economy? Well, financial channel minimum. I don't see major financial channel impact for the financial markets. Because why? Because there's no derivatives built on the debt of Evergrande, and also over 100 banks are involved, each of them being relatively exposed relative to their own capital. Okay, so it's not going to be a systematic one. Okay, however, the impact is on the real economy, because with the default of Evergrande, there will be slowing down of development of many projects. So the real property market will have impact on the GDP growth rate for the coming years because of slower finance for the whole sector.
Okay, so just to recap what you're saying, the contagion risk is minimal in terms of financial contagion. More troubling or more worrying is economic contagion, what it could mean for an economy already engineered to start slowing down and to get back to tackling this mountain of debt that China has built up. But back to this whole idea of common prosperity, we've seen pictures and we've read a lot of reports that a lot of, and I stress here, these are mostly middle-class Chinese people. This is a growing demographic who got caught out very badly investing in some of these Evergrande wealth management products, and who were also very angry. So, as important as the middle class is to the government and to the party, this potentially could become a political problem as well, you have to admit.
Correct. Okay, so let's first talk about the general idea of common prosperity. Common prosperity should be understood as a vision or long-term goal of the government. That is to try to promote upward mobility of the currently poor people. It's through faster urbanization, through more public provision of education, of healthcare, so on and so forth. Now, come back to the issue of Evergrande and its default on wealth management products. Well, again, I think that what will happen is that there will be quite a lot of subsidies for individual and low-income investors involved in the Evergrande. Okay. However, the brunt of the impact of the default of Evergrande will be borne by local governments and by the hundreds of commercial banks who are able to use their own capital to absorb the loss. Okay, so I do not think, again, the Evergrande issue default will become a huge issue for the financial markets. It will be a big issue for the property market through the slower development rates of investment, and also lower impact and the lower growth rate for the whole GDP.
Okay, and so this guy really made the most sense out of everything that I've come across. Key difference is that unlike the U.S. crisis of 2008, where we had derivatives, CDOs, collateralized debt obligations. Hang on, let me turn this off. Collateralized debt obligations, they ran rampant up and down Wall Street. We don't see derivatives with Evergrande. Okay, it's not there. Evergrande moved away from their core business. They sold bonds to use debt financing to fund both their real estate and their non-real estate ambitions. And now they cannot repay their debts owed. Countless businesses and people are rising up. And the CCP knows all too well the history of China and the power of their enormous populace, combining the two words there. So again, the key difference, derivatives. Okay, U.S., they had derivatives up and down all over the place. China, none. So really, it's held, it's roped in, it's fenced in, and it's just more about keeping liquidity to the local economy, the economy within China, to make sure businesses can continue. The average mom and pop investor, they have a little bit of perhaps maybe safety net's not the right word, but there is some kind of a justice in some sense. I mean, I guess some kind of something to ease what's going on to keep that liquidity going. So there's a big difference, and you didn't hear many people talk about that. Thankfully, this gentleman did. And so now though we do see or did see how the PBOC has started injecting liquidity into the system to grease those wheels and keep them moving. But again, this is locally. It's not systemic the way we saw it with the US. So China injects 18.6 billion into banking system during the Evergrande crisis. This came out September 22nd last week. So the central bank boosted its gross injection of short-term cash into the financial system after concern over a debt crisis at China Evergrande Group roiled global markets. Remember, all the global markets got scared, and we saw the markets fall. So the People's Bank of China, PBOC, pumped 120 billion yuan or 18.6 billion into the banking system through reserve repurchase agreements. Now, does that word sound familiar? Reverse repurchase agreements. Sounds like a repo, reverse repo, resulting in a net injection of 90 billion won. And that matches the amount seen on Friday and was just below that of Saturday. Sentiment was also boosted after Evergrande's onshore property unit said it plans to repay interest due Thursday on its local bonds. So I guess we can let me just go through a little bit more here. PBOC's net injection is probably aimed at soothing nerves as the market worries about Evergrande, said Eugene Leo, senior rate strategist at DBS Bank in Singapore. While the aim may be to instill discipline, there is also a need to prevent contagion into the real economy or to other sectors. So that's kind of how China is handling it. And again, it's because there were no, or I should say there were no, but the derivatives weren't as they weren't so irresponsible with these types of things the way the U.S. did it and Wall Street did it. So basically, to wrap it up concerning Evergrande, a Beijing bailout is what we're going to see. It seems like a soft bailout just to keep the local economy going, and I'll tell you the truth, I kind of admire that. I do admire that I think they're handling it in a very good way. They're taking care of it and making sure that people are responsible and being held responsible, and that everybody understands the mistakes that have been made and what's going on. So you got to kind of admire that. Whereas U.S., we just did it an entirely different way, and I think China's doing a better job with this, to be honest. So anyway, that'll end the topic of the day. We'll move over into commentary. Before I say mine, let me take a look at yours. Um, let's see. Mr. Nguyen, real estate is China's number one enemy. I mean, in fairness, you do have to go back and remember all those ghost cities that they built, right? The ghost towns, ghost cities. And I think to this day, people still really haven't moved in. And people there, they really, the only things they had to invest in were real estate. China has some pretty tight policies as far as investments or money moving outside. So people invested locally. So okay, there's a point there. Let's see. John Bethea, if our politicians, what they did like China, we would have better politicians. You guys are going to debate that one for sure, but I understand what you mean. With it, I don't know if you could call Western politicians elitists the same way you could call, let's say, the politicians in China elitists. But I think the difference is, you know, in China they do have that more of for the greater good type of mentality. Uh, Sadly, our politicians in the West, they go in poor, they come out multimillionaires, and you got to kind of wonder. You went in a public servant and you've made multi-millions and millions and millions of dollars. How'd you do that? So you got to kind of wonder about those things. Um, it's things are getting pretty corrupt, and it's not able to be kept fenced in anymore. More and more of us, we are really starting to see this already. So that's we really got to see two sides of this coin. Okay, I'll just move over to my commentary. As Gerald Salenti says, the bigs are getting bigger, and probably you and I, we're not in that club. And every country will print and throw money around to stop a business from collapsing and a domino effect. Amazingly, though, they might save a name like an Evergrande, but are killing the idea of what money represents. And this is for everyone. And because of that, your money, your wealth needs to move away from an assured fiat self destruction. You and me, we have to work for our money. And if we invest, we took the risk. That is plain and simple. We took the risk. And if that value of money is not really anything more and not what it is meant to be anymore, we're in trouble, friends. We are in trouble. And we, now and then, we have to know how to protect our money, our wealth preservation. You don't protect your fiat from self destruction with more fiat. You do it by moving assets that store the value of all that you have worked for. And history tells us that is without question gold and silver. Wealth protection is for everyone. It is absolutely for everyone. That'll end the commentary, or wrap up the show. I'll take a look at a few more comments before we head out. Let's see here. Okay, fair point. Xavier's J. I think China is in a lot worse. They do have debt. Make no mistake. They do have debt. So let's be clear on that. They're in a lot worse shape than they're leading one to believe. I think they'll provide the catalyst for the coming collapse. Could be. I mean, we'll see how this unfolds. I mean, this is something that keeps changing day by day. So we'll see how it all pans out. Let's see. What else is out here? Harold B. Never forget the populace of China has 120,000 tons of gold. U.S. citizen can't find $600. So it's tough. These are tough times for sure. Definitely tough times for sure. Let me just see if I can find one more comment, and then we'll wrap it up here. Let's see what else is out there. If there's anything else. Yeah, Mr. Nguyen, that's true. They have to rein in the risk hazard. Everybody needs to rein in that risk hazard. If not, I mean, like I say, history tells us when the currency really just basically self-destructs, they end up bringing in a new currency. We see this happen over and over and over again. Weimar Republic, Zimbabwe, wherever you want to look around the world, currency gets in trouble. They bring in a new one, and that new one they do look to bring in are, of course, central bank digital currencies, which presents a whole nother set of issues. So interesting times ahead for sure. But with that, I better be letting you guys head out, get some sleep, or get back to your work day. Appreciate you being here. Appreciate the thumbs up. So again, do subscribe. We got Egon Von Greyers coming up, and then I think we're going to have Peter Schiff, so it should be pretty interesting. So subscribe, hit the bell, thumbs up. Always appreciate it. Be a blessing, not a burden. We all know what's going to happen, so let's make sure we take care of ourselves, our families, and if we can even extend to our friends. And as always, saddle up for what's coming ahead and silver up as well. I'll see you guys next week or 2 weeks from now. Take care.